working capital and working capital management. So working capital and working capital management is one of the very important concepts in accounting. It's one of the key aspects which any investor looks upon before he makes a decision to buy a particular business. So when we say working capital, it goes alongside with the operating cycle of the company. When we say operating cycle, it is how quickly the cash which is utilized by the company can be converted back into cash itself. So when we start with cash, the company deploys cash into purchasing raw materials. And once the raw materials is purchased, it forms an inventory of raw materials. And then it is put into work in progress to finally produce its finished good inventory. Once the finished good inventory is formed, it then sells these products to eventually generate cash. And in between, from the finished good inventory to the cash formation, there is a intermediate step that is called as a trade receivables. So this is the entire operating cycle of the company, and how effectively this can be managed can be determined by the working capital management. So working capital management ensures that a company has sufficient resources which it can be deployed to meet the short-term obligation or short-term operating costs of the company. So the way working capital is calculated is by taking the current assets of the company and then subtracting with the current liabilities. So the difference of this is going to tell us how efficiently the company will be able to fulfill its current obligation. If it's a positive sign, it's a great company. That means it's able to manage its finances very effectively to produce sufficient cash to meet its short-term obligation. If it is a negative, then the company might have to rely on raising capital for itself, or even it could end up in bankruptcy. So there are various ratios which can help us determine how effectively the company is managing its working capital. There is days sales outstanding, that is one of the ratio. Now the second ratio is days payable outstanding. And then there is another ratio which determines how fast the inventory can be converted into sales. That is inventory turnover ratio. These are the three key ratios which can be used to determine how effectively the company is managing the working capital. And of course, the working capital has to be a positive sign. That is the fourth component in our analysis of a company. So using this analysis, we can determine our great company before we go ahead and purchase it. So please subscribe, and going ahead, I will be sharing a lot of further accounting rules and further valuation ratios and further valuation methods which can be used to determine the fair value of the company as well. So looking forward in my subsequent videos. Subscribe. See you until then.